Hi everyone, Larry Bailey here, Mortgage Workflow Partners. This is for the market recap going over the week of May 5th, 2025 in review. There's a lot going on. What I want to make sure is that if you're listening to this on podcast, thanks very much, but head over to masteringencompass.com to watch the entire video in its full. You want to go through the screen share because we are sharing important information that you can only see on video. So here's what happened. The Federal Reserve maintained its pause on interest cuts, taking a cautious, quote, wait and see approach amid ongoing uncertainty about tariff impacts. Meanwhile, housing markets nationwide continue to show price increases while job seekers are encountering more difficulties. Here's the stories you're going to hear about next. First one is Fed holds steady on rates, takes a, quote, wait and see approach. That story is followed by homeownership remains a solid investment option. That followed by latest unemployment claims, finding new jobs is taking longer. We have a family hack of the week, and then we're going to talk about what we're going to look for this week. By the way, earlier today, obviously the stock market took off like a little bit of a rocket ship because of the news for the trade talks over the weekend. So we'll kind of wait and see what happens there. Talking about wait and see, let's get into this first story here. The Fed holds steady on rates and takes that wait and see approach. The Federal Reserve unanimously decided to maintain its benchmark Fed funds rate, or the federal funds rate, at 4.25% to 4.5%, continuing the pause established in January. This is a widely expected move because it comes as the Fed acknowledges the increased risks to both inflation and unemployment. It's important to remember that the Fed funds rate affects the overnight lending rate between banks, influencing broader interest rates throughout the economy, though they do not directly set mortgage or long-term rates. The bottom line here is the Fed remains focused on its dual mandate of price stability and maximum employment. That's the reason why they're in business. So when these goals may pull policy in opposite directions, of course, with these new tariffs creating economic uncertainty, higher inflation typically prevents rate cuts, while economic slowdowns usually triggers them. So given this uncertainty of the impacts of the trade policies, this is where Fed Chair Jerome Powell emphasized a cautious approach in his post-meeting press conference last week, quote, where he said, quote, we think right now the appropriate thing to do is to wait and see how things evolve, close quote. Thank you, Mr. Powell. Powell used the word wait over 20 times during this Q&A session. Looking ahead, the Fed will closely monitor the upcoming inflation and employment data, of course, as future policy decisions could depend on what risks materialize first, either economic downturn or higher unemployment. All right, so let's get to the next story here. We've got homeownership remaining a solid investment option. So it is said home prices nationwide rose steadily in March, with Cotality, that's the new company name, used to be known as CoreLogic. They reported a 0.6% monthly increase and a 2.5% annual growth. ICE, that's the Intercontinental Exchange, that's the same company who owns the New York Stock Exchange. By the way, same company who owns ICE Mortgage Technology, which owns Encompass. Anyway, ICE data similarly showed 2.4% year-over-year gains. Bottom line here is that the experts are bullish on continued growth, with Cotality projecting a 0.9% increase for April and a robust 4.9% appreciation over the next 12 months, up significantly from their previous 4.2%. I don't know if 0.7 is significant, but, there it is. These numbers reinforce why homeownership remains a powerful wealth building strategy, blah, 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 blah. I'm going to tell you right now that the longer you wait, what they're trying to say is here, the longer you wait, the more you pay. Should you wait? I'm always going to say, again, I started in banking in 1986. I started in mortgage banking in 1993. And where there's some times where maybe you should have waited to buy something, overall, generally no. All the houses that I've ever seen cost way more now than they did when I first saw them. Just the way it is. So sooner you can buy something, sooner it's probably worth more money in the long run. Please be careful on what you invest in because nothing's guaranteed. Be prepared to lose, is what I always say. All right, next story here. Latest unemployment claims, finding new jobs takes longer. Initial jobless claims dropped by 13,000 to 228,000, remaining near historically low levels, Continuing claims, they fell by 29,000, 1.879 million, down from the previous week's 1.908 million, which by the way was the highest since November of 2021. Bottom line in this story is while new unemployment claims stay low, the overall trend of continuing claims reveals an ongoing and concerning problem, which is workers are spending more time being unemployed after losing their job. The median unemployment duration has increased from 9.8 to 10.4 weeks, while the average duration has risen from 22.8 to 23.2 weeks. For those of us that aren't math nerds, the differences between a median and an average. A median is the most common number that comes up in the data set. So the most common number that comes up in the data set of unemployment is 9.8 to 10.4 weeks, like that band, right? Whereas the average time out of the whole thing is 22.8. So there's a ton of people on both ends, but the most number of times for weeks people are unemployed is between 9.8 to 10.4. That's your math lesson for the day of the differences between median and average. So whatever you want to say here is these numbers still confirm that finding new employment after you become unemployed is becoming more and more difficult as companies delay hiring amid economic uncertainty and tariff concerns. You want to talk about food? Here's a family hack of the week. It is time to celebrate National Chocolate Chip Day. It's happening May 15th. Use this chocolate chip recipe, which is a recipe to make chocolate chip scones. It's courtesy from King Arthur Baking. Yields 16 to 18 scones. Check them out. You could freeze scones. I didn't know that. Check out the recipe at this spot in the replay and let us know how you made out if you made these. Here's what we're looking for this week, gang. We're going to watch for crucial inflation data with April's consumer price index being released Tuesday with a producer price index, that's the wholesale. That's arriving Thursday. Thursday also brings out the weekly jobless claims report, April's retail sales figures. We've got this month's home builder confidence also reading. That's Thursday. And the housing picture rounds out on Friday with April's housing starts and building permits data. So we got a lot going on. Up here at the very, very top, you can see the cost of money is getting more expensive. You can see the 10-year Treasury yield has gone up to 4.47, and we can see that the mortgage-backed security for the 30-year 6% coupon is now worse by 19 basis points. The lower that is, the worse rates are. The higher this yield is, the worse rates are, obviously. So any questions at all about all this stuff, head over to masterencompass.com and let's chat. We'll see you there. Guys, have a great rest of your day and rest of the week. We'll see you next time.